All right. So tonight we're going to talk about stocks, bonds, the term project, and those kind of things. So again, I find the stock market part especially pretty interesting. Bonds, not so much. But stocks, investing in companies, mutual funds, it's really it can be pretty rewarding, and that's where a lot of wealth is generated. And then, like I said, if you can get that wealth, then maybe you can transfer it into real estate or something else that might be a little bit more stable. Or you can keep it in a stock portfolio. A lot of people do that, but I've just never been one for having some of the stocks. Once they get kind of boring, I'm out, and I'll put it into real estate, which is also a little bit boring, but you can enjoy it. But anyway, stocks. So stock exchanges. Some of this stuff, again, maybe I need to change up these slides a little bit because some of the stuff is getting a little dated. I mean, this gives you, sort of a history of like the stock exchanges, but you as the customer, you as the retail investor, you really don't care so much about, you want the company, and whether it's listed on the New York Stock Exchange or it's traded over the counter or whatever. I mean, it's just like ordering something. You need a part for your car or whatever. Do you care whether you get it from the local auto parts store or you get it online or whatever? Sometimes there's some difference in delivery, some differences in charges, but the difference with stocks is that, like, different stocks tend to be traded on different exchanges. Some of the big boy stocks that are, some of the big bellwethers that have been around for a long, long time, they're maybe on the New York Stock Exchange, and then other companies that, well, the tech sector has kind of disrupted a lot of this, because a lot of those tech sectors companies that weren't necessarily whatever, they dwarf some of those old established companies, and they're not even traded on the New York. So anyway, you don't so much care because you're not physically going to be there. In fact, a lot of people aren't physically going to be there. Most of this is done electronically, but even that it does play a role. It with the automated trading and some of this stuff, it really gets to the point where the speed of light, the speed of electricity does make a difference. And we'll talk a little bit about that as we get more into the complexity of the trades. But for retail trades, for doing trades like we're going to do, not a huge difference. You just want the stock and you don't care where it's traded. Obviously, New York is the largest, the biggest, but you've got the American, not so much. You've got some regional exchanges, you got some foreign exchanges, but again, trying to trade on those like the London Stock Exchange or the Japanese Stock Exchange, the Tokyo Exchange, it would be nearly impossible. You would want to use some sort of intermediary, probably invest in a mutual fund that has exposure, or those foreign companies that might be listed on U.S. exchanges, rather than trying to trade on those exchanges if you're not a resident of those countries. Okay, OTC, huge. So NASDAQ is huge, and a lot of great companies are listed on the NASDAQ, and there's no physical location tied to it. I mean, there's a building for their offices, but it's mainly just electronic trading. So, and that's how things are done. After hours trading, reasons why you might not want to do this. If you're trying to sell a stock, for example, there needs to be a buyer on the other end. And if you're trying to trade stocks in the middle of the night, I mean, maybe it's daytime someplace, but the main, the majority of the volume of a lot of companies is done within the U.S., and so to trade after hours could be a little dangerous, because your stock, you put out an order out there, and there may be not very many buyers in the market at that particular time, and so there might be some price distortion. You want to trade when there's lots of volume, and you can predict with pretty good accuracy what your trade's going to execute at based upon the previous trade that took place a few milliseconds before. So a lot easier. Anyway, all this will make sense as we start getting more into trading. Price quotations, this is where they kind of lose it with me. Internet is where it's done. Stockbrokers, stockbrokers are not quite gone the way of travel agents and full service tellers. Actually, they probably are a lot like bank tellers. They still maybe have a role out there for some huge transactions with some high wealth clients, but for most of us, it just represents somebody who needlessly gets a commission and will also probably give you bad advice. Stockbrokers, every time I used a full service broker back in the day, and we're talking a long time ago, I was overseas, I was in Middle East and stuff, and so I had money, but I didn't have the ability to research things and trade on a timely manner. So I used a broker, and the strategy was I'd trade with a broker, I'd lose a little bit of money. I thought I was probably the only one, and then sure enough, I'd get a letter in the mail from a class action lawsuit saying that particular brokerage overrepresented a stock and presented false information because they were getting some sort of commission. So I was not getting fiduciary advice. I wasn't getting unbiased advice, and I wasn't necessarily their customer. I was just kind of a pansy who was getting played. So financial newspapers might, well, newspapers in general, or maybe there's online versions, but print is just kind of, it's not timely enough. But especially in quotes and chart information is just so much more useful. We'll talk more about that. But the numbers you need, that hasn't changed much, within a range. So whatever that range is you specify, they'll present you this tabular data. So the high is the price that it traded for, through the course of that period. The low was, in this case, $49.40. So it went into this like $20 or $12 range. And a stock company, the name of the company, I guess they're paying a dividend in this case, but normally you talk about a stock ticker. So, a company is not typically spelled out. It would be whatever they ended up with a ticker symbol, an abbreviation like ZUG or something like that. Obviously, there's a lot of companies out there, so not everybody gets the name they want. Ford Motor Company, for example, has been around since the beginning, so they are the letter F, just F. No numbers, no extra characters, just the letter F. Most companies don't get that kind of power. They have to, take it's like internet domains where you have to choose from what's left over. PE, price to earning ratio, not necessarily something I look at because most of the companies I'm involved in are growth companies. So you got to know the characteristics of the company. If it's an established company that should be making money, yeah, there should be a significant PE, price to earnings ratio. But if it's a startup, Amazon was unprofitable forever until they were, and then they were incredibly profitable. Volume, yeah, so they've got volume. You don't want, whoops, we just had a page change. You don't want something that's thinly traded, meaning there's not a lot of volume. So a price fluctuation on a low volume day is not really indicative. If you get near Christmas, the market's going to be closed on Christmas Day, but within a few days of Christmas, it's probably not the best time to trade because the volume is very thin. There's not very many buyers and sellers in the market, so there could be some price distortions. So it traded in this range, and then it closed out when the market ended. It was at $50 even, and the change over that period, I guess for the day, was only up 27 cents. So that's some information. It comes tabular like that, but let's look at what's really available. So here we go with, this is modern charting data. Everything's interactive. You bought it here. Here's the date, the close, the open. People visually, it's just much more intuitive. What's the range here? So this is from all time. So NVIDIA, NVDA is the ticker symbol. Price, how much it's up, what percentage that represents. All the numbers you need. After hours trading events. You scroll down here, you get some news. If you see the price change a bunch, what's causing that? There might be some information here. Just all kinds of information. Now, NVIDIA is unusual, and I'll use this kind of as an example, because their stock price of $140.41 A couple months ago, this would have been represented by $1,404 and $4.10, but they had a 10-for-1 split. NVIDIA is a great company in terms of price appreciation. I bought it back in this range for, I wish I would have bought more and I wish I kept it all, but anyway, I bought it somewhere around $37 back in the day. And I jumped out when it hit $800, so that would have been about $80. I had to stop in foolishly. Anyway, I got out, so I made, good money. But then I bought back in with some when it dropped back down to $900, so roughly about equivalent today of about $90, and I'm back in with not as much money as I had, but some. But I put some of those winnings into Bitcoin, so maybe it'll all work out in the end. We'll see what happens. But anyway, so yeah, this is just much more powerful. And if you want to look over just the course of a day, so you can see it's been kind of choppy today. 5-day, 3 months, 6 month, year to date. It's got little events on here. You can capture a thing. You can hold the cursor there and tell when it's gone from there to there. And I mean, it's just so much more information that's available. Now, all this technology and charting is kind of a two-edged sword. You come up with some great concept for how you're going to beat the market trading stocks, and you've got some sort of formula. Well, before you can even do that, there's probably somebody who's figured out that formula, and has automated it and is trading on it. So it's really difficult to implement some strategies when there's so much information available, and there's a lot of basically disgruntled math professors from several university professors who didn't feel like they were being quite earning the pay they should for the amount of intelligence and effort they're putting into it. And some of those guys migrated over to the investment business. There's a number of those folks who did that a few years ago. Well, 10, 20 years ago now, and they are kind of killing it. They've done really, really well. And so it's there's so much money involved. There's a lot of really smart people who have put some time into it. So, okay, so we were looking at the data, and I told you how this is kind of outdated. Especially if it's printed in a newspaper, it's useless. It's too old by the time you're seeing it. Those charts are updated. Typically, you can get real-time quotes. Sometimes you have to pay for them. Delayed quotes, delayed by 15 seconds, you can generally always get those for free. And believe me, seconds matter when you're trading a lot of money. And so that's why they can sell that. Selecting a broker. So, again, not a big fan of broker. I will use a brokerage, and my primary, selection, and it's not hard to find, is a no-cost broker, and those are available. Just about everybody is a no-cost broker, or no fee, no commission. Now, sometimes you got to be careful. There are some services, maybe Robinhood or a few of these other ones, and I think they're all kind of guilty of this. They will do a thing called front-running the trade. And again, I'm getting into the weeds here, but it's important that you kind of know the concept and how these people think. That if they know, say, you're going to be buying NVIDIA stock, theoretically, you as a retail investor, you're not going to make much of a dent. But if they amalgamate a whole bunch of orders, and let's say Robinhood's got, going to be buying $1 million worth of NVIDIA for their customers, that information is incredibly valuable to somebody who's going to front run the trade. So if they were to give that information just by a few milliseconds to another trader who can get in there and perhaps buy a little bit of NVIDIA, knowing that the price is going to take a little bit of a bump due to the increased demand for that $1 million order coming in, you can make a few pennies, and you multiply those few pennies by a lot. And so literally companies will pay for real estate with, closer proximity to the New York Stock Exchange or wherever the main computer that's doing the trading is located. And just that, that speed of light, that speed that electricity travels, is enough to execute some of those trades. So anyway, that's really down in the weeds, but it is something that they often accuse some of the real discount brokers of doing by selling basically the data on upcoming trades to people who are going to execute on it. So anyway, what I'm looking for in what this role that they're talking about, they're looking for some sort of advice, some sort of guidance, some sort of analyst recommendations. I want that from somebody who doesn't have skin in the game, who is not going to get a higher commission the more I buy. It's very dangerous to somebody who wants the churn. The churn is what they call where you're buying and selling constantly and they're making money on commissions. So these guys, if there are no commissions, then that incentive for them kind of goes away. What I do want, though, is I want the best information possible, and you can generally get that now. You're probably not going to get it for free, and if you are getting it for free, it might be of dubious quality because they may try and manipulate you into purchasing a stock to inflate the purchase price of that stock. So I don't know whether you are offended easily by movies, but the old Leonardo DiCaprio movie, the name escapes me right now. It's going to come to me by the end of the lecture. But that movie was quite good at explaining the pump and dump scheme. Pump means you get a in this case they use penny stocks because penny stocks are stocks that are traded for less than $1 in value. So they're traded in, denominated in pennies. And so they escape a lot of the SEC, the Security Exchange regulatory, environment, and they don't have to do the same sort of reporting. And so you have a hard time getting information on these companies, and they can, give you this insider information that this is the best company ever, jump in, and the price just by the hype gets driven up. And it gets driven up to a certain point, and the guys who hyped it at the end of that, they sell it all and take the money and run. And it's the movie I'm thinking about is The Wolf of Wall Street. And so there's a lot more to that movie, but the concept regarding what he gets involved in with these fly-by-night companies selling penny stocks and doing pump and dump. That Jordan Belfry was the guy who did all this, and that is 100%. Truthful. The guy did his time in jail, and he's now out. There's some other movies though. That The Big Short, great movie, very much more informative. A lot to that one, and it explains shorting and all those kind of things, and some of the bad things that could happen in the market. Maybe not quite as applicable to you on the personal investing side, but certainly if you're taking part in the U.S. economy, those tactics are out there. And then there's another thing called Dumb Money, which is also a stock one. And I'm sure there's going to be a crypto one to come out here pretty soon, but right now I can't think of a great crypto movie that kind of explains that. That whole field's kind of evolving. Anyway, brokerage commission. So discount brokerage fee. I mean, we're talking beyond discount. We're talking most brokerages are no commission, or no commission at all. Full service, kind of the dinosaurs. Maybe have a limited role, but not what they used to be. I got job offers as a stockbroker a couple times, and they did not care a rat's whatever about my investment advice. The interviews did not talk about any of that. In fact, they were kind of disappointed because at the time, I was a big runner. I've run several marathons. I like to go hiking, but not with the big group, and they weren't into that. They wanted tennis, they wanted golf, they wanted sales skills. They wanted you to be out there, schlepping this stuff to your friends and, being social in these groups, and you were a salesman. You weren't necessarily they'll tell you what to sell. You just need to do the selling. So I don't have a whole lot of respect for that area. Okay, purchasing and selling stocks. So, name of the stock, yep. Again, with automation with the internet, you type in Tesla and it's going to not care whether you know the ticker symbol. I think it's TSLA. But anyway, doesn't matter. The internet can figure all that out. So not a big deal. Buy or sell? Yeah, obvious. Are you buying or are you selling? The number of shares. This used to be a big deal back before automation. Computers do not care whether it's a round lot or not. They even have a calculator where you type in how much money you want to spend, and it tells you how many shares out to multiple decimals, and it's going to do that, and nobody gets upset. There's not some guy in a pit yelling out, whatever, 10 General Motors at whatever. Nope, it's a computer, and the computer isn't bothered by odd numbers. Again, here's that chart I showed you. We were just looking at it a second ago. It's just captured here in the slides. And here's from a few, this was back before the split. So in today's prices, this would have been 95. So like I say, it was a 10-for-1 split. Nobody made any money on the split. I mean, the company definitely had momentum, and it was probably going to go higher. So having a stock split is a good thing, in terms of it shows that the company's growing. But the reason they split it is just to make it more manageable. I mean, if it's $1,400 a share, it's just awkward. It's like, only having $100 bills in your pocket. It's neat, but it's not that useful when you go to the store. All you want is, a drink or something. It's not going to work. So they try to reduce it. So if you had, one share at this price, the next day after the stock split, you've got 10 shares, but they're only 1/10 the value. And here's how you buy and sell. You hit the buy or you hit the sell button. It's dead easy. This is a thing from Fidelity, is the brokerage I was using. So this was back in March, so last spring, that spring term. And when you get in there, you tell it what you want. So here's that ticker symbol. Here's the company, if you forgot. Here's, more information, what it's doing today. It was up 1.5% or 1.3%. Bid and the ask, so there's a bit of a spread in there. So if you're buying, it's this much, selling that much. Volume, that's how much is being traded. And what do I want to do? And so I've got all these different things. I told it I wanted to sell. Now it needs to know how many. Here's the calculator. If I type in, I hit this, there's going to be like a dollar sign, and I put in, $10,000, it's going to calculate and auto-populate this with the actual number. Now here's the interesting bit. I can do this different ways. I generally just about always do market orders because I'm like, I'm ready to pull the trigger right then. But you can do different things. You can hit a limit order saying, yeah, it's trading for $9.55 right now, but I've seen it bouncing around. I've seen it as low as $9.50, $9.40 today. I think it's going to bounce in that range because it's being volatile. So I'm going to put in well, actually I'm selling here, so I want it higher. So I think it could potentially get up to, say, 970 or something. And if it gets to 970, I want to sell. So I put in a limit order, and I put 970. A conditional one, I'd have to hit on this and see what they mean specifically. It's conditional probably upon a volume or something. Stop loss, stop limit, trading stop, trailing stop. Okay, so let's say we're doing pretty well, and I want to get out at a certain point. And let's say I'm pretty confident that the stock is doing well, but I think it's still going to go higher. And but if it goes down like to $925, I'm getting a little scared. In my case, this stock was trading around here at about $900, and I said, if it gets below $800, I'm out. I don't want to ride it all the way back down to $37 or whatever it's going to be. So I put in a stop loss order, and I put in a stop loss to sell at $800. And because the stock was volatile, it went down. It hit that stop loss number, the $800, and when it did, it sold all of my shares. So the good news was, it didn't fall. I captured my profits. But the bad news was that it just really tapped at the 800 and then it started its progress and went on up. So, there's no free lunch. Now, if you have a trailing stop, you can do this. What you do on a trailing stop is, let's say the price keeps going up and you want to, again, conserve, maintain that profit you've already made. So let's say you're happy with what the stock's doing. You don't want to sell it outright. You don't want to have a market order. But let's say, if it drops by more than $50, I want out. Okay? Or you say, if it drops by more than, 5-10%, you specify that number, I want out. So it will establish what that price is right now. So right now it's $955. And if you say, if it drops by more than $50, I want out. If it drops down to, $905, your trailing stop order now became a market order, became executable, and you just sold. But let's say the stock price goes up the next day. These things stay in effect overnight. They can stay generally out to 90 days, whatever their limits are. And here's the rest of the things too. I'm sorry, I'm reading you these, going through these definitions when they're right here in front of us. So anyway, so you can look down here if you're getting confused by my verbiage. But anyway, let's say that the stock price goes up to $975. You're doing good. It's going the direction you want it to. Well, your trailing stop, it's not a stop limit. Stop limit is fixed. A trailing stop, you said you wanted $50 lower than that highest amount. So now your trailing stop moves up. So now it would have to drop down to $925, and then you'd be out. And so let's say it keeps marching away and it's up at whatever, $1,400 right now. Well, your trailing stop would follow right along, just $50 behind that, and would not execute until the stock starts to retrace. And once it came down by more than $50, your order's executed. So it's pretty powerful, especially if you're not going to sit there and watch the market all day. If you want to just, plus it's like eBay or anything else. The more you watch it, the more you're likely to get emotionally involved and make stupid decisions. If you come up with a strategy, you put your strategy in place and you let it go, you're typically going to make better decisions. So anyway, so purchasing and selling stock. So here they go through. Market order, exactly, sell right now. Limit order, only if the price was within the limits. I appear to be having a dogfight, my apologies. Stop orders, there's more than just one kind of stop order, but this is a simplified one. So we had stop limits, we had stop, we had trailing stops, all kinds of cool stuff that are available to everybody. You don't need some fancy account. Every brokerage offers that kind of stuff. Stop orders, yep. And then order online, low commission, no commission. Now, I got Trevor Stocks doing this, my apologies. Okay, so on margin, don't do this in a nutshell. Unless you really, if you know enough to say, you're going to do it anyway, then maybe you do. But for 99% of us, trading on margin, it's not going to work. You're going to be out. So margin means using credit to purchase stock. And so I think I explained a little bit of this one time before, where you put down a portion of the funds. Now, obviously, Federal Reserve limits, it's got to be at least 50%. So you buy $1,000 worth of stock, but you only use $500 to do it. So it's a way to increase your leverage, increase your buying power. Now you can control more stock with less. But the problem is if your stock, your margin is going to be denominated in the value of that stock. And if that stock starts to go down, you no longer have, you owe them $1,000, or you owe them, you've got $1,000 worth of stock, and you needed to maintain 50% of that value, so you need to keep $500 in there. And if the stock price goes down, you still owe them $500. And now the value of that stock isn't what it was, and so you would need to add more money. You need to essentially buy more stock to get up to that limit. And you get in sort of this death spiral. And you get a margin call. You get a call from the brokerage saying you need to add more cash to get back up to the level. And if you can't do it, if we can't reach you, if you can't put up the cash or don't want to put up the cash, well, we will sell your stocks, and we'll sell them at the lower rate. And so you can, normally volatility, if you're not margined in there, if there's some sort of stock market anomaly or even a crash, you're not out. You're not selling that day. You haven't lost any money. You just wait, and you wait for the market to recover, and then you do what you want. But if you're going to be, in a market that's volatile, and for the most part the stock market is volatile, to have leverage is a dangerous thing, because you can get aced out of the market. Now, in real estate, buying stuff on margin, that is the way it's done. That's because real estate is not that volatile. So it makes a difference, but not all credit is bad, but sometimes credit can be very bad. And buying stocks with credit is typically a very bad practice. Short selling a stock. The movie The Big Short can explain this far better than I can, but this is their definition. Borrow stock from another investor, you'll have to return it. Sells high and buys low. So what you need to do is, I've done this with Tesla stock at a certain point, and I was expecting Tesla stock to go down. This was years ago, and Tesla was fairly volatile, and it was based upon an election back at that time, and I thought the price was going to go down a bit. And so you buy the shares of the stock, but you don't actually pay for it right then. You buy the shares of the stock, and they were trading for only like about $80. But I expected the share price to drop to about $70, and it actually did that. And so I sold those shares short. I specified that when I was buying the shares. I sold them short, and so there's somebody on the other side of this trade that accepts that position. And sure enough, the price went down, and that's when I had to buy the Tesla shares. And I think I had 500, and I had to buy 500, but I bought them at a lower price. So that's how it works. Anyway, shorting your mind can get all twisted up. But if you look at The Big Short, or even the Dumb Money, they will go a bit more in detail. Again, these are not necessarily something you as a novice retail investor will have to do. Now, the reason why it's important that you know all this stuff and that we're kind of going in depth in this stuff is because although you may not be executing all these trades, you want to have enough knowledge that you can have an intelligent conversation with, or at least intelligently read the materials from maybe the mutual fund company or whatever. When you're investing in a fund and they talk about how they're going to grow the fund, and they talk about short selling, when they talk about, buying stocks on margin and all this other stuff, what their strategy is. You also know that, it's probably inherently more risky than just sort of buy and hold strategy. But hey, maybe you're after a higher return, and maybe somebody who's doing it full time and has a proven track record of success in doing it, maybe that mitigates a lot of the risk. So that's why we're kind of going into some of these details. Okay, when you're looking at a company, when you own stocks, you own equity. You own a portion of that company. And so what determines a stock's price is its valuation, but it's based upon, stocks are always priced forward looking. What is the outlook for the stock? Like I said, Amazon was not making a profit, but the stock was soaring because there was an anticipation that this company knows what they're doing and there's going to be huge profits in the long run. And so in trying to size up a company, there's a couple different ways to do that. What I just talked about with Amazon, that's more of a fundamental analysis position, where you look on the characteristics, the revenues, earnings, the sensitivity, all these different things, the product. This is like sort of there's the Oracle of Omaha, Warren Buffett. He's kind of a fundamentals guy. He looks at different propositions. He's at Omaha. He sees the fracking going on. He knows that there's a lot of oil being produced, and at the time there was no pipeline. And so what's going to happen? How's all this oil going to get around? It's going to go via train. So he didn't buy the oil so much as he bought the train. He owns CSX. He owns some other train thing. He owns the people who make Justin Boots and all these other boot companies. He likes products that you can kind of reach out and touch, that are adopted, and he's not into speculative stuff. I mean, he would not buy something like Twitter. I used to invest quite a bit in Twitter back in the day, and that's something he would never touch, because how do you value a company like Twitter? This was before they even found a way to really do the online advertising successfully. So anyway, a fundamental analysis that's more what I'm in tune with, and it's more understandable. Technical analysis, this is charting. These people, they look at charts, and that's a cup and saucer, and there's a head and shoulder, and all this stuff, and it's in this one band, and it is if you're exceedingly good at math and have got those kind of skills, these people, they don't really even look at the company so much as they look at the charts, and that's what they go by. And it's really, and the charts, all the charts really reflect is more or less human behavior. I mean, the reasons the numbers on the charts go the way they do is because people are buying and selling. So it's also just it's very complex, but there's both kinds of traders out there. Some focus solely on technical analysis and some on fundamental analysis. And the good ones are, they can be successful in either field. For me, I definitely favor fundamental. I understand some of the patterns on the technical analysis, but I never have confidence in my selections. And the ability to analyze this has been, unless you're very deep into the programming and the other stuff, that a human as compared to a machine who can pick up on these patterns far quicker, act on them far quicker. If you're in technical analysis without some sort of automation, you're done. It's fundamental analysis, not so much. Okay, firm's financial condition. So you've got a balance sheet. Now, all these statements, they only work when you're comparing them one against another. You can't just look at a lone company. Let's say you're looking at buying, either Apple or IBM or Dell Computer versus somebody else. To compare companies in the same sector of roughly the same size, it's hard to do, but you really need that sort of comparison. You need to, a standalone balance sheet will give you some information, but the most useful information, and for also an income statement, is needs to be compared against one another. And again, certain companies, and a lot of times the fast-growing companies, you're investing in the expectation of what's going to happen. If you're looking at a company that's paying a dividend and is established, these documents become quite a bit more important. But something in the high-tech sector, and again, that's where I've done most of my trading. These documents aren't as valuable because the current position is not what you're buying. You're buying the future. So, supply and demand, everything is like that. Price goes up if people are confident in it, and a lot of times there can be some hype out there. Now, the good thing about larger companies is the Securities Exchange Commission actually does have some teeth. If say you're somebody, and Musk has gotten in trouble with this with Tesla, if he makes some crazy comment that influences the stock price, and it's deemed to be manipulative or anything else, he could go to jail. I mean, if you're a registered officer of one of these companies and you make comments that can, adversely infect investors with bogus information, you've committed a crime. So those guys, they have to be very cautious in the way they can talk, so they can't hype things to the same extent. The penny stock type things, that's a problem. Not so much. They can say they've developed something and they've got something in the pipeline, and this is the next big thing, and there's really no recourse against them. But the larger companies, they have to be very careful and very precise in what they say. Accounting frauds, there's always been accounting frauds. Yeah, Enron, WorldCom. Those were a couple back in the day. Now you've got all the insider trading. You've got all this stuff that doesn't even take into account 2007 and some of the other stuff that's going on. So fraud's always going to be out there. And there's just too many people making money off it, including politicians. So hoping for enforcement is fairly optimistic. Anyway, analyzing economic conditions, huge. Again, getting back to the tech sector, they love low interest rates because they want to borrow money for investing, and so they're very interest rate sensitive. And these guys, these authors didn't even have things like COVID that can affect things. Right now, we're in a almost to the end of an election year, and so the administration that's in power, regardless of party, is always going to do things to do whatever they got to do to kind of get the economy going. Try and lower the interest rates as far as they can, and so this is generally October is generally a very good month for investing, as is an election year. So we could be seeing some pretty good gains from now through the end of the year, and depending on your political choices, you may be really optimistic or really pessimistic, depending on your particular candidate. I'm hoping that things go the direction I want to, and I'm incredibly optimistic, but we'll see. So, GDP, gross domestic product. Yep. All the goods and services produced in the country. So they compare GDP amongst countries. Fiscal policy. So that means the financial situation of the company, how they get things done in terms of setting interest rates and the rest of it. The U.S., and this isn't just being I guess I'd be nationalistic or whatever, but the U.S. still is pretty dominant in terms of economies. Europe actually has sunk back a bit. Japan is not what they used to be. China obviously is very big, but they're not as open and therefore don't have the same latitude to move things around. They are a bit different. So if the U.S. economy, goes down, they always say if the U.S. economy has a cold, the other countries get the sniffles, or whatever the expression is, to say that most of these countries are so interrelated. And India, obviously, big. So there's a lot out there. There's a lot of opportunities out there, but with all the multinational companies and all the companies with exposure throughout various countries, it's very rare to see one country excelling when the other ones are failing. Interest rates. Yep, everybody likes low interest rates. Some stocks, like I said, tech sector, hugely susceptible to interest rates. Now, so the Federal Reserve is it's not necessarily a branch of the federal government. It's the selection of the personnel. They're essentially owned by the big banks, or funded by the big banks, but it's in the government for some roles and outside of the government in other roles. Anyway, they try to do what they can to set interest rates by establishing the monetary policy. So, there's different ways that interest rates go up and down. The biggest thing and the most, concrete way to move interest rates is based upon, the business cycle. What businesses are doing. If there's higher demand for money, interest rates, should go up. If there's lower demand, interest rates tend to go down. But the Fed will also get involved, and they'll try and set the interest rates or manipulate the interest rates by doing things like printing more money. And there can be downsides to that. Well, there will be downsides to that. So when you print a lot of money, as they did during COVID, you see inflation just start to go because there's so much money out there chasing the same amount of goods, and so prices tend to go up. So they try to control interest rates. Pretty controversial what their success is, but they have probably a larger role than a lot of people would like them to have, but they do have that role. So inflation, and this is what happens where you still have your, say, $100, but what you can buy with that $100 can definitely change, can definitely go down. Now these price indexes, very political, because they'll take things in, they'll take things out, they'll use other approximations for things they don't have data for. So basically they can fudge the numbers. And the problem with this is a lot of government expenses are tied to these indices. And so the politicians in power, they want to portray this as a lower number if at all possible. That helps them with all the entitlements, Social Security, veterans benefits, all that stuff, military pay. It's all tied to the price index. And if they can keep that number low, they won't have to shell out as much money. Also, when they've got as much debt as they do, if they can keep interest rates low, they don't have to, pay as much money to service the debt. So, whatever. You could listen to all sorts of different sources, but realistically, some very smart people have said that the true debasement rate, the value of the U.S. dollar is going down by about 14.7% per year, which is a pretty high number. Hopefully, if it is that high, it won't stay that high. But yeah, it's pretty devastating. Industry conditions. Yep, industry indicators. And there are certain cycles that will take place. You can't necessarily control all of that. But then you can look at the different analysis. So they're kind of talking about, how to value companies, how to buy companies. Personally, I go with sort of a fundamental analysis. One of the things I bought, and I made a bit of money on, was Lululemon. And this is primarily due to having a couple daughters and also being when I was teaching, on campus, I was teaching a larger load, and the students, there's just so much Lululemon out there. And the company is pretty well run. It's a Canadian company. Anyway, it was kind of a no-brainer. But I don't really want to base something upon, not looking at the financials. So I looked at those, but again, you're kind of getting a snapshot. There are analysts in there that, are making recommendations. And at the time, I was actually subscribed to a service that recommended stocks. So if you're going to be involved in buying individual stocks, it might be worth your money to pay for an actual subscription. Now, getting information free on YouTube, getting information free wherever, it's usually worth what you paid for it. They may be trying to hype something. They may have good advice, but nobody's paying them for it. So, if they could sell that information, they probably would. So anyway, it wasn't super cheap, but I wanted validation. So number one, it needed to seem like a good idea to me. I wanted to check out the financials, and then I wanted another recommendation from somebody who's doing this 24/7 to say, yeah, that's a good idea. And so then I bought, and it went well. So good stuff. Factors that increase the stock price. So, yep, supply and demand, and just the overall economy. So that overall economy factors in that interest rate and inflation, which is going to be related to it, and consumer demand, which is going to be inflation. So it's all kind of tied together. It all comes down to supply and demand. Things that are good for demand and things that are bad for demand. So it's all about the future. You're not buying, the stock price is what it's trading for today, but it's a forecast of that company's health. If a stock price is trading for a high level, that means that there's high confidence in that company. If the stock price continues to go up, the absolute price of a stock is not necessarily that indicative of the health of a company. It's what the trend is, whether it's going up. And if the stock price is going up, that means that there's a favorable view of that company. And getting back, just one thing. I mean, even for free on here, there'll be some recommendations typically. Earnings date, forecast. Maybe not. I have quite a few investments with Fidelity, so I actually get recommendations. Here's an analyst rating. So Jeffries, rating action, maintain, rating buy. So this guy's got the stock, but they're recommending buy. Price action raises. They're saying a target in this range. I want to know the time frame that they're talking about. But anyway, I mean, even for free, you can get a recommendation of certain things. And NVIDIA is kind of a no-brainer. It's they did super well. I bought them because they had graphics cards, and they were the dominant one, and that's why I bought it way back when. And then they got into these graphics cards were super powerful, and they were being able to use for Bitcoin mining. So everybody was buying them for that. So there's an artificial demand for that. And now they make a lot of the chips and boards and stuff for the AI related things, so it's an insatiable demand, so they're blowing up. If you aren't familiar with NVIDIA, you're probably not wanting to jump right into stocks just yet, because it's a name that would be quite familiar to you. And again, I got a recommendation from Fidelity. They gave me a call. If you've got a certain amount of money with them, they assign you a personal advisor. And this guy called me up and he said, "Wow, you did really well as NVIDIA. How'd you do that?" And I'm like, "Okay, you've already qualified yourself as somebody who is completely unqualified. If you didn't see NVIDIA coming, I mean, to see it 10 years ago, you had to be fairly sharp, but to not have seen it in the past couple of years, you needed to be asleep at the wheel." So, Okay, so we'll talk more about stocks as we go, but pretty interesting stuff. Bonds, bonds are not an ownership position. You don't have equity in the company. You're making a loan to the company. So long-term debt securities. So different than stocks. I mean, obviously you can't have stock in the government. That'd be some other form of government. But you can make loans to the government. So, and then also corporations. Par value for a bond, face value, whatever. If I say you're buying a $20,000 bond, that's what the par value is. And a maturity, let's say it's a 20-year bond, that's a maturity date. So the game plan here, the bargain is that you give them, say, $20,000. So it's a $20,000 par value. It's a 5% bond. So they pay you 5% of 20 grand every year, annually. Maybe they'll do it in different payments, but quarterly perhaps. But anyway, big picture is you get 5% per year, every year, until the maturity of the bond. And let's say it's a 20-year bond. At 20 years, you obviously kept all those payments, and now here's your $20,000 back. So you get your $20,000 back. A grand. Again, time value of money. Your 20 grand doesn't have the buying power it did 20 years ago, but just the same, you got all that money back. Now, you don't need to keep it that long. If you've got a security that can be traded in the market, just like you probably bought it in the market. So you can buy these things secondhand and sell them. So can you sell that bond for $20,000, a year or two afterwards? It depends on what the current bond yields are. If you've got a 5% bond, and bonds have since been issued that are paying 8%, you go to sell your $20,000 bond on the market and you want that money today, we'll give you 18 grand, because it's not as attractive as that bond if they went out and just bought a new one today. Conversely, if rates have gone down and the bond yield is now only 2%, and you've got a 5% bond, people will offer you more than $20,000 for your bond. Now you can say, screw it all, I'm keeping it for the 20 years and I'm going to get my 20 grand back. Fair enough, and you can do that. But if the rates have changed, you're either sacrificing or gaining by not acting upon that. But anyway, you don't have to keep it to maturity. They make the interest payments, repay the par value is what I said. Call feature, not a good thing for you. Let's say, because the economic times are what they are, let's say they're offering an 8% bond, and the company is offering that bond, and you're like, that's great interest rate, I'm going to take that. Well, there might have been a call feature that you signed up with. It would be explained to you, if that was the case. But let's say interest rates now drop down to 3% or something, and that company's paying you 8%. They're like, yeah, we don't want this deal anymore. And there's a call feature, so the deal's off. Here's your 20 grand back, and all your payments cease because there was a call feature. So it doesn't work out to your benefit. If you're the bond holder and the bond gets called, not a good deal for you. So they give you a slightly higher return to offset the fact that it might get called. Convertible, yeah, you can switch them from a debt position to an equity position. That's a convertible bond. So this goes into the details I was talking about, where the coupon rate, that interest rate, if it's above or below, is going to change the value. Bond trading in the secondary market, yep, that's where you sell them. So you sell them in those same exchanges. Again, you really don't, it's kind of transparent to you what exchange it's sold in. You're just interested that it's selling. Treasury bonds, these are guaranteed by the U.S. government, the U.S. Treasury, so not going to pay a lot of interest because there's not a lot of risk. Guaranteed, so no risk essentially as long as the federal government's still there. Exempt from state and local taxes, which may make it more advantageous, especially if you're in a higher tax rate. Yep, sell in the secondary market. Munis, municipal bonds. Again, local agencies, low risk, although some municipalities have been known to go belly up. You know, go out of whatever, go in debt. They aren't the federal government. State and federal governments can't print money. They can't borrow money. They can go in debt, or they can't, you know, print themselves out of debt, and so they can fail. And then the federal bonds. Interest is taxable at the federal level. Yep. Corporate bonds, subject to default risk. Yep. And then high yield bonds. So it depends if they're selling it to you, they're going to call it a high yield bond. If they're evaluating it or you're holding it, you might call it a junk bond. The reason why they're paying a high yield is because they have to. Nobody wants them. If you're getting a bond that's paying 20%, that's because nobody wants to buy it at 10 or 15%. They realize it's not a highly rated company and may go out of business. If they stay in business, woohoo, you're making 20%. If they go out of business, you lost it all. Now, you do have an equity, or not an equity, but if it was a stock, you would have an equity position and you would be part of that company and your money would absolutely be gone. Since you're a debtor, since you're loaning them the money, theoretically, if there's any assets left in the company, you're entitled to, you know, part of the proceeds from those assets when they're sold, when the company goes under. Good luck. Good luck getting that money back, but theoretically you could. So the quotations, you can find these on those same graphs, but yeah, the numbers that would be important is that coupon rate, the maturity, the yield, the volume, closing price, net change. So if you're going to sell in the secondary market, these would be things you're tracking. And again, just specified in tabular data. But again, yeah, I guess traders, you know, there's investors and there's traders. Traders are people who generally, you know, trade stuff and they're making money just on that, and they're usually much shorter term, whereas investors are more of a long-term outlook. And then you get speculators that are very short-term and usually in riskier investments. Speculators and traders might be synonymous in a lot of cases. Investors is generally a more disciplined, buy and hold, long-term approach. So this is what I was explaining to you before. Interest rates rise, the value of your bond decreases. Interest rates have gone up, new bonds are being issued that pay more, so nobody wants your stinky bond. Interest rates falls, all of a sudden your bond is more attractive because it's paying the old higher rate. Tax implications, yeah, ordinary income, and yeah, if you make money, if you sell a $20,000 bond for $22,000, yeah, the government wants tax on that $2,000 you made. Time value of money, yep, a lot of math involved to figure out whether it's a great investment or not. Companies got to be in business to make the payments, and yeah, companies can fail. Now, there's rating companies that do this, Moody's, Standard & Poor's, but again, these grades that they're assigned to them, you have to kind of know what you're talking about, or you have to be familiar with them. You know, a B-rated bond may not sound great, you know. It's a A through whatever, F schedule, but anything below a B is junk. So most of us would be pretty happy with a B, but not in the bond market. Impact of financial crisis. Yep. So again, if they're paying you a very high interest rate, there's probably a lot of risk associated with that. So you can see B, BB, we're down in the junk range, which is crazy. So these guys are competitive, and so they have slightly different things. But you can also see, if you, in The Big Short, they pointed this out in part of the movie, the guys are going around, and this guy senses this weakness and this failing of the entire financial system, and yet I think they were in the Moody's office, and they were still saying things were good, you know. Now, what happens is these bond rating agencies, what they were doing, the way things happened in 2007, that whole crisis, what lenders did was they got a bunch of, you know, people who shouldn't have been buying homes or should have only had one home, and these people were speculating and had multiple homes. You know, they had these, what they called ninjas, you know, people with no income, no assets, you know, nothing, no income, no job, and they're selling these people homes, and so they didn't have the financial wherewithal to pay these loans back. So if they were rated, you know, they would have been down in the junk quality. But what they did was they got all of these subprime mortgages, all these loans that were made to people who didn't have the means to pay them back, and they grouped them together. They amalgamated them into one big pile. So they got these little individual pieces of poop, and they put it together in a big heaping pile of poop. And for some reason, they said that all of that stuff together was better, you know, because it was more diversified, because you had all these different people, and the odds of them all not paying at the same time, well, that was somehow less likely. So anyway, they ended up with a big steaming pile of poop that they pushed up into the rating category. They called them collateralized debt obligations, CDOs, and anyway, it's a very educational movie. I would definitely recommend The Big Short. It's just well done. It is fairly negative towards a lot of capitalism and stuff. So they show mainly the downside, but some of the things they got right were how all of that happened and how all of these rating agencies were asleep at the wheel because they didn't want to, you know, their primary customers are the banks, and so they didn't want to give the bad news to the banks, so they just went ahead and played along and overrated those bonds and basically falsified the soundness of those debt obligations, and it all came crashing down. So, yep, a call. So, call, not good thing. The bond's being recalled. We're giving you your money back. The deal's off. Interest rate risk. Yep, interest rates can go down. So, and then appropriate bond maturity. You might want to time it. You know, you're going to get a bond, and you're going to get this $20,000 back just at the time your youngest is going to be, you know, ready for college. You can do things like that. Interest rate strategies. Yep, different bonds, different times. Again, trading bonds, maybe if you're really into it, but I've just never found the same excitement as in the stock market. And I realize that shouldn't be a primary investment criteria, but, you know, the worst thing to do would be get a bunch of bonds and just ignore them. So if you don't find them interesting, you might not generate your interest and your time and your due diligence that you need to spend with them. Maturity matching. Yep. So the college education thing, stealing my idea. All right, so that's with stocks and bonds. I guess we're going kind of long here, but I do want to tap on this term paper. Always get questions because not any student is created equal. All students are completely different in terms of what their situation is. But for a typical student who's still in college and doesn't is just getting by and trying to minimize their loans and doesn't have some financial portfolio, it doesn't make a whole lot of sense to, come up with this cosmic plan that you can't really execute right now. So if you're in that situation where you're not in your career yet, kind of fast forward yourself till when you've graduated from college and you're in your sort of dream job, and you're going to have to do a lot of guesswork, a lot of forecasting about where you think you're going to be to set out those initial parameters. You can look at things online to figure out about what you would get paid in that profession, and then come up with, say, a percentage you're going to save and how it's going to be invested, and then go through and answer some of these things in sort of a checklist manner. As you're doing your study, I would look at a lot of these brokerage companies and see some of the free stuff they have available, and look at some of their tools and take screenshots and figure out what kind of life insurance you might be interested in, and know just how dismal Social Security output is if that's your sole source of income. There's a whole lot of people, for one reason or another, have arrived at a position in life and they have no retirement savings, and they think, well, I'm good, I've got my Social Security. No, you're not good. You're not going to enjoy those years of your life to the extent you should, because and anyway, I'm not judging on how you got there, but it's not going to be a well, money's not everything, but it's going to be exceedingly tough to enjoy life without being so driven by money, if you're dependent wholly on Social Security. Anyway, I guess that's about it. Yeah, just think about all that stuff. Start drafting your paper. People will send me copies of their plan, and that way, I can give them some input and tell them, yeah, if you submit this right now, you're going to get a B. If you tweak it a little bit, extend the length a little bit, put in a little bit more data, you'll get yourself up to an A. So if you don't get an A on the term paper, that's on you. You fully can, everybody can get an A on this paper just by getting it to the point that it needs to be. I'm not, again, I'm not looking for some cookie cutter type thing, because everybody's different. If you hit the page length and you appear to have put in the time, and you didn't give me some, whatever Chat GPT generated garbage, then yeah, you're going to get a good score. If it looks like it wasn't even written by you and it's generic and it's got, just so verbose that it's unreadable, then yeah, that's not good. But most people who hit the page length generally get the full point. It's people who, at the last minute give me a paragraph and unfortunately their grade suffers. So, good luck on that, and we'll talk to you next week.